I'm Morella Fernandez. Thanks for joining us today on Market Call. We have Brian Madden here, Chief Investment Officer of First Avenue Investment Counsel. He's taking your questions today on North American equities, and here's how to reach us. You can call us toll-free, 1-855-326-6266. You can send an email as well, marketcall@bnnbloomberg.ca. So, Brian, thanks for coming in today. We have a lot of questions, but I do want to start off with the new GDP numbers just because they are brand new. We saw an uptick, annualized at 2.6 growth, and I'm wondering if you think that was mainly because of the cut in the interest rate.
There could be some, tailwind effect from interest rates, but probably that's not the primary causal factor. Interest rates, of course, impact the economy with a long and variable lag. Usually economists would say it's somewhere between 12 and 18 months. So, I think it's just sort of underlying strength in the economy. We've seen good jobs reports, not consistently over the last 12 months, but there's been a string of them recently. So, I think there's other underlying factors, but certainly at the margin, the rate cuts are probably providing some lift to Canadian economic output.
Okay, let's dive into the markets. You see markets continuing in a bull trend for 2025, both the U.S. and for Canada. And I'm wondering if that means you're not overly concerned about the tariff threat.
Well, so this is the number one topic of conversation in news circles and business circles, around dinner tables, and really everywhere you go. And so I would say it's not a threat that you want to be dismissive of because, the threat, if followed through upon, would be impactful to Canadian households, businesses, and the economy writ large. So, it's risk management is about probability and severity. So the severity of the threat is high. In our assessment, the probability of it being carried out as threatened or promised, whatever, choose your verb.
I think threatened is probably a good word, yes.
Yeah, I think that's what most Canadians would say. Americans might say promised, although they should be careful what they wish for. Because every mainstream economist anywhere in the world understands and knows that tariffs are paid by the consumer in the importing country, and they already have high inflation in the U.S. So, long story short, I think the best analogy is in poker. You play the man, not the cards, and we have the good fortune of having seen quite a few hands dealt, particularly on this file in Trump presidency 1.0, and so we know that this adversary or player, counterparty, has certain tells, and so. The typical playbook here is opening gambit is shock and awe, bully, bluff, bet. And you sort of bring your adversary or trade counterparty to the table, and a deal is struck, and a MAGA victory is declared with or without substance, and on you go. And really, what is the end result of it all? It is all to bolster the Trump approval rating in the home market. And so, I think as odious as it feels to many Canadians to be treated this way by our friend, our neighbor, our ally, our soldier in arms, with centuries of history going back together, we do need to come to the table and we need to put our game faces on because, this is a serious file. But we do see an ongoing bull market. And so as much as economists and strategists might pull their hair out and wring their hands over this wall of worry that's tariffs or any number of other things. Economists and strategists tell you what they think the market should be doing. Prices and volumes and charts will tell you what the market is doing. And so on that basis, we see the S&P 500 and the TSX Composite putting in a series of higher highs and higher lows, and that is the definition of a bull market.
Okay. I'm sure there are a lot of investors who just want to be on side with absolutely that vision for the future, because we've been talking, as you mentioned, about the uncertainty for quite a while. We are going to take a quick break. Line up your phone calls for Brian Madden, Chief Investment Officer, First Avenue Investment Counsel. Again, taking your question today on North American equities. We're back in a moment. Welcome back to Market Call. Thanks for joining us today. We're going right to your queries. We have an email first from John, who is writing in from Whitehorse. John says, what are your overall thoughts on Enbridge? both currently and going forward? Is it likely to continue its current decline? And where might one find a solid entry point? Thank you for any insight that you can offer. Enbridge is a good solid one, but it has been coming down.
Yeah, that's true, Marilla, and thank you very much for the question, John. So Enbridge is not a company that we own in either of our two North American equity mandates at First Avenue Investment Counsel. Our preference within that energy midstream space would be TC Energy. Having said that, this is a mighty solid company and probably the second best of this peer group. And so this pullback, we do think is viable. And just for audience context, this is about a $130 billion market cap company with about a 6.3% dividend yield. It's managed to grow the dividend at about a 3% compound pace over the last 5 years. And notably, that is a significant slowdown in the pace of dividend growth from a decade ago when they were doing all sorts of financial engineering and the cost of funds was lower and they were able to lever up more and it was easier to build infrastructure, frankly. But nevertheless, you put together the current income from that 6-point-something yield and another 3% growth rate in the dividend, and even absent any re-rating, you have a good line of sight to a high single-digit total shareholder return over a cycle. And I should stress that this is not a business that is particularly cyclical or prone to technological disruption or even really to commodity price fluctuation, which might seem counterintuitive, given that they're in the business of moving gas and oil. But most of their business, 90+%, is rate regulated and it's fixed price take-or-pay contracts with little volume risk. They also have a downstream division, which heats most of our homes here in Ontario. So that's about as steady as it gets. Bull market, bear market, recession or expansion. It's cold here this time of year.
Especially with the weather we've been having lately, yes.
Yeah, ain't that the truth? So, we need to heat our homes, and most of us do it with gas. And also, they're greening the company slowly but surely, bit by bit. They've got a renewable energy business, which is solar and wind and other things like that, that comprises about 10% of their business. So this looks like a pretty good entry point, frankly, although we don't own it ourselves.
Got it. All right, let's move on to our phone lines. John is on the line calling from Milford, Ontario. Hi, John. What's your question today?
Good day. I would like your thoughts, Brian, on Bank of Nova Scotia going forward. I've owned it for a long time, and with the tariff threat, what's your thought? Thank you very much. Bye.
Scotiabank reported this week it beat expectations.
It did, yeah. Thanks very much for the question, John. So we don't own Scotiabank, although we'll say we did take a deep dive and spent a full day at their investor day when the new CEO, Scott Thompson, joined just about a year and a half ago. Intriguing. I think the strategy reset under Thompson is an explicit acknowledgement of the fact that the previous strategy really wasn't working. And recall, Marilla, that this is a bank that for a long time held out the promise of being exposed to faster growth emerging markets in what they call the Pacific Alliance countries, so Mexico, LATAM, and South America.
And now they've pulled back from some of that, right?
Yeah, they have. And I think, that was recognition on their part that, the promise or the return and reward associated with some of these higher risk emerging markets never really justified the risk. There was a lot of credit loss provisions and difficulty doing business in some of these countries, currency risk and so on and so forth. And so at the investor day, the management team laid out a plan to identify businesses as being either feed capital strategically to grow, hold and maintain market share businesses, and businesses that were underperforming or subscale or otherwise problematic that would be put on a very short leash and either turned around promptly or exited via a divestiture or just an outright closure of them. And so that all made sense, in theory. Strategy always looks good on a whiteboard or on a PowerPoint slide, but devil is in the details. And so the first couple of moves in terms of strategic portfolio repositioning under this new plan, one of them was taking a minority stake in the United States, which sort of checked one box. They wanted to get bigger in terms of their footprint and presence in the U.S. But they did so via a non-control position in KeyCore with no clear path to control or ownership or synergies with the rest of their business. That was a bit of a head scratcher. And then as for the other side of it, businesses that weren't earning their cost of capital or where they couldn't grow, they identified Colombia. And so that business wasn't really even making money last year. And so they sold that business a month or two ago, but it wasn't a clean exit. They took back an equity stake in a larger bank in Colombia. So in a sense, they're still tied at the hip to the fortunes of that business. Now they just don't have any control over it. So this is really a show me story. And although the shares have re-rated along with the other banks, we just don't think this is one of the top 3 banks. And to be clear, we run high conviction, fairly focused portfolios. So we don't want to own all the banks. We want to own the best ones. And this one doesn't make the cut for us.
Got it. All right. Thanks for that. A lot of information behind that one, right? So let's go to Sal, who's on the line from Toronto. Sal, what is your question today for Brian?
Thanks so much. Yeah, given the impending Trump tariffs, I've been looking at sectors that would be more defensive to such a move. And so I was looking at the engineering services area. Stantec came to mind immediately. They just had recent earnings. WSP, that's their peer, also just had their earnings. So I was wondering, what would be your thoughts on Stantec, if you think it's a good entry point, and if you can also talk about WSP in that as well, and what the prospects do you think are, given if there are tariffs, what it would mean. Thanks so much.
Big questions this week are, where do I hide, right? Where can I hide out and be relatively untouched by what could come next week?
Well, yeah, and these are the right questions to be thinking about. You know, you don't necessarily want to make binary all in or all out bets on whether there will or won't be tariffs, because frankly, as an investor, our visibility into those outcomes is negligible. You know, frankly, the president himself probably doesn't even know what he's planning to do until the instant he does it. So, you know, we'll see, but you want portfolios that are going to be resilient to almost any sort of economic condition. So I think you're thinking along the right lines in identifying services in particular. Services aren't goods, so they're not going to be subject to these border tariffs. Engineering services are further advantaged by secular growth opportunities. So Stantec is not a company that we own. We did own it probably about a year and a half back ago. We do own WSP Global. My colleague Ian Chong attended their investor day a couple of weeks ago. I was quite impressed with what they had to say, similarly impressed with their recent results put out a couple of days ago. So we do like the sector. You know, these are companies that are operating in you know, building and engineering. Some of them are helping to design, construct, and build data centers. A lot of them are involved in environmental and water remediation.
So things you think could not go wrong because they have to go forward, especially on the data centers.
Well, the data centers, I mean, they'll ebb and flow, but certainly there's a secular tailwind there. But similarly, the environmental services businesses are advantaged by things like climate change. This is flood remediation and ruggedizing, you know, buildings against extreme weather and that sort of thing. And then they're also in the civic infrastructure business to a certain degree, hospitals, schools, all that kind of stuff. So, you know, in the United States, Stantec has a meaningful position. The U.S. is growing faster than Canada, so it should do fairly well on the back of that. Although a lot of the revenues from these kinds of companies do tend to come from governments of various stripe, whether it's municipal, state, provincial, or federal. So if there is a massive paring back of the U.S. federal government, as certain individuals are endeavoring to do in rather unorthodox fashion, that represents a bit of a risk, but I don't think it negates the otherwise strong secular tailwinds that engineering and construction design service companies face. So I think you're good with this one. We prefer WSP Global, though.
Got it. All right. We are going to take another quick break, but we have Brian Madden, Chief Investment Officer, First Avenue Investment Counsel, answering your questions today. Here's how to get hold of us, either by phone or by email. Your questions on North American equities today. We're back in a moment. Welcome back. Thanks for joining us here on Market Call. We're going right to your questions. Again, John's on the line from London, Ontario. Hi, John.
Hi. Hello, Brian. The Magnificent Seven have been flat to downward trending. for a variety of reasons. Google is still the cheapest. Meta was the most resistant to the volatility, and Tesla may have a political advantage. Which of these 7 stocks do you think will rise above the ashes? Thanks very much.
Yeah, thank you, John.
Where do you begin with the Magnificent Seven? I'm not sure.
Yeah, I guess they're not all equally magnificent, let's say. There's a super magnificent one for political reasons and the rest, but that doesn't really color our thinking on them. Our work at First Avenue Investment Counsel is rooted in deep fundamental analysis and to a degree rounded out by macro thematic considerations, by quantitative analysis and technical analysis. So we manage 2 equity mandates, and across those 2 mandates, we own 3 of the Magnificent Seven. So to us, it's a Magnificent 3, I suppose you might say.
You slimmed it down.
So the ones we like are and own are Microsoft, Google, and Nvidia. Nvidia, obviously, for its tremendous technological and first mover advantage in semiconductors, and in particular GPUs and other chips for artificial intelligence and data center applications. It reported good results a couple of days ago. The stock is pulling back in what looks to us to be a still long and strong continuing secular uptrend. Microsoft, obviously, household name, needs no introduction. We like that one, again, for the secular opportunity in cloud computing, via their Asia business, their entrenched dominance in household and business applications, their more personal computing segment, and rounded out with various other smaller pieces of their portfolio, but a very stalwart grower trading at an undemanding valuation. And Google, of course, is also
is Google.
It's ubiquitous. It's so ubiquitous that the name of the company has become a word. Google this or Google that means look it up. When I was a kid, my mother would tell me, go to the library and look it up, but you don't say that
Not anymore, no. Google it.
Google it.
Absolutely. Okay,
so yeah, leader in search advertising. So those are the ones that we like of the Mag 7. Not to say the others aren't good, but again, we're selective and concentrated and high conviction portfolios, so we want to own the best of them, not necessarily all of them.
All right, let's go back to the phones. Jim is on the line. He's calling from Elliott Lake today. Hi, Jim.
Hi, good afternoon. Brian, I'd like your thoughts on National Bank, probably the least talked about of the bigger banks here in Canada in comparison. I guess over the shorter term, I know it's short term, but it's been kind of sideways, even to the negative, kind of 6 to 9 months here. Pays a nice dividend at 3.8, but your thoughts on it today, and could this be an entry point?
Yeah, thanks very much for the question, Jim. I'll start out by saying we don't own National Bank. But I will say, in all candor, what I colloquially refer to as my woulda, coulda, shoulda portfolio, like roll back the time machine 10 years ago.
And they're in that?
Or 15. Yeah, this is the one that really, we used to talk about a big 5 banking group, and we don't anymore. We call it the big 6. So National Bank, over the course of 10 or 15 years, slowly, not overnight, kind of grew up from a Quebec-based regional bank that you would compare to the other regional banks, those being Laurentian Bank and previously Canadian Western Bank, which has now been acquired by National. But it outgrew all of the other regional banks, and it took a well-deserved seat at the so-called big boys table, and now it's part of the big 6 bank group. And it is an exceptional bank in personal and commercial banking, good wealth management business. And packs a big punch for the size of the company in terms of capital markets. It's got a very good and dynamically growing capital markets business that had standout results when they reported on, I believe it was Wednesday. And then the opportunity in front of it is to integrate its recently acquired Canadian Western Bank, which has got to be right up there with Royal acquiring HSBC Canada in terms of hand and glove fit and very synergistic, strategically sound, and very likely accretive deals. So I think there's lots of blue sky in front of this one, and we have no qualms in adding it to a portfolio,
What's
frankly.
the footprint for Western?
Canadian Western Bank has its roots in Alberta. It over-indexes to commercial lending, but it had been branching out and trying to expand its footprint into central Canada. And so now with the combined sort of physical footprint and reach of these two companies, it's going to be very much a coast-to-coast bank before too long.
Got it. All right, let's go back to the phone lines. We have Gord on the line calling from Oakville, Ontario. Gord, do you have a question for Brian today?
Hi, Marilla. Hi, Brian. Brian, I have a question about Agnico Gold. I've been dipping my toe in gold and have a small holding on it, but I'm thinking of increasing it. What is your opinion going forward? Thanks, Brian.
Thank you for the question, Gord. So yeah, our toes are in. We're toe, foot, ankle, and knee deep. We like gold, and we own it in considerable size in both of our equity mandates. And the gold price chart is moving up and to the right, just as you'd want to see, and so is the shares. So are the shares of Agnico Eagle, which we've owned for just about 3 years and continue to like and own. So what we like about it, excellent management team. The long-serving CEO, Sean Boyd, retired just a couple of years ago, inducted into the Canadian Mining Hall of Fame. The current CEO is a long-tenured veteran of the industry. So that's important. When you have an extractive company, there's necessary and sufficient conditions for success. The necessary condition is you have to have good assets. They do, and the sufficient condition is the management team has to be prudent and disciplined with capital and operations in order to extract the value of the resource and the reserve. So this is a company that operates 12 mines, very low political risk jurisdictions, Ontario, Quebec, and Northern Canada, and Nunavut, Mexico, Finland, Australia. There are various types of mines, some underground, some open pit. Some have short remaining lives, some are going to produce for a very, very long time to come. They've got a couple of the biggest mines in Canada with Canadian Malartic and a Detour expansion opportunity there. So, Meadowbank up in Nunavut is another great asset. And so this is a company that runs a pretty low cash cost, all-in sustaining costs around $1,300. So when you think about where gold prices are trading, just under $3,000.
Yeah, 2847 is what I have now.
Yeah, it's going to be massively cash flowing. The company does pay a dividend, and it is pretty good about increasing it. Put a bit of a pause in the dividend increases the last couple of years after acquiring Kirkland Gold and delevering. I think they are now debt-free, or they very well soon will be in a quarter or two. So we would likely expect to see a return to that cadence of dividend increases. So I think this is a comfortable, sleep well at night, well-diversified, well-operated gold mining company with a very long and storied history. So I think it's a good way to play what we see as an ongoing bull market in gold commodity.
All right, we do have to take another quick break, but when we come back, I'll look at Brian's past picks. That's coming up next. Welcome back to Market Call. We have Brian Madden in-house. Time now to take a look at his past picks. The picks are from March 8th of 2024, so almost a year ago, just shy of a week. We're going to start with Brian's pick of Pool Corporation out of New York. And a year ago, it was recommended at 415 American. Now it is at 346. So a significant drop here, minus, I guess, or 16% down, 15% down for total return. What happened with Pool?
Yeah, this one didn't work out in all candor. It's not a household name, although I would imagine viewers will deduce what they do from the ticker and the name of the company. But to make it perfectly explicit, this is the leading distributor of outdoor pools and related supplies, consumables, and garden and sort of adornments for outdoor living. Pools, in particular, in the United States, almost exclusively, a bit in Europe, but and a bit in Canada, but mostly it's a U.S. business. It's an excellent business. I want to be very clear about that. It has very few competitors, and it had a massive boon in the COVID era because people were cocooning and staying at home. They couldn't go out, et cetera, and they were spending a lot of money to sort of make themselves more comfortable in their own backyards. And so this company had a tremendous surge in sales for a couple of years, and then COVID ended. And then they had very difficult comparisons for about 2 years. And we introduced it into our portfolio, a little over a year ago, thinking that the period of difficult earnings comparisons was going to soon be in the rearview mirror, and that with the Fed likely to start cutting interest rates in 2024, these purchases, which are often debt financed, would start to become more compelling again. And moreover, there's just an underlying base of demand. If anyone who owns a pool knows they eat chemicals and parts and machines like nobody's business. So that bet was wrong, frankly. The Fed moved more slowly and less boldly than we had foreseen, and consumers were more reticent to open the checkbooks for big ticket purchases. So we sold this one at about exactly this price in August of last year and moved on.
Got it. All right, let's move on to your next past pick, the Hershey Company, which at the time, almost a year ago, was $194.56 American, and now has dropped to $172, almost $173. So down 11%, total return 8%. What's going on with Hershey?
So same thing, Marilla. So this one didn't work. There was the thesis. The thesis was negated by subsequent findings and facts, and we sold this stock at about $197 in early September last year. And so I think, I say that in all candor. We make lots of mistakes, but we try not to compound them by digging in our heels and fighting the tape and, making up narratives to support continuing owning things that aren't working and that the prospects don't look good in the medium term. And so what went wrong here, this one, again, is a household name, so iconic chocolate and candy, a little bit in salty snacks. And that sort of thing, primarily a domestic business, about 10% of it's international. But there was a lot of inflation in agricultural commodities, notably cocoa, which went up about fourfold over a 1.5-year period. It's still going up, but other commodities too, sugar and dairy and nuts. And for a while, Hershey was able to pass the cost inflation on through price increases because it's an iconic brand. But as the cumulative effects of inflation started to build up, the consumers started to retrench a bit and pare back their purchases. So what economists would call price elasticity. And then cocoa continued to move higher and higher and higher. So again, we cut our losses and moved on and avoided a further 15% or 20% drawdown in the stock. So I think as an investor, you really do have to look in the mirror. We can make lots of excuses. Why didn't pool work? Because we blame the Fed or blame the weather or whatever. Why didn't Hershey work? Because the Ivory Coast organic cocoa crops weren't very good. No, we just got something wrong. And so, you don't fight it. You rip off the Band-Aid, take your lumps and go and pick again and avoid the opportunity costs of further drawdowns, which is what we did.
Okay, but let's go to your next past pick, which was a big winner, of course, Shopify. Recommended at $102.87 last March, now $159. A return of 55%, total return of 55%. So Shopify continues to do well.
Yeah, so this is a name we've owned for quite some time in our momentum mandate. Great work has been done on this name by my colleague Ian Chong. We continue to like and own it. It's not quite a verb like Google, but it is a category-defining e-commerce enabler through basically e-commerce in a box for small and medium-sized enterprises. But increasingly, they are serving and catering to large enterprise customers because they're just that good. Large enterprises, that could ostensibly do their own e-commerce in-house, instead use the Shopify platform. And then beyond that, there's the ancillary revenues, so payments and shipping, and the attach rate for those ancillary services is growing and growing and growing. I think it's up to close to 3% now on a gross merchandise value that just keeps growing inexorably, outgrowing the overall value of e-commerce markets in their addressable markets. And by the way, they're just getting started in terms of attaching payments in some of the markets in which they operate. I think they're only doing payments in 19 countries, but they're operating in over 100. So, we have a lot of admiration for this company, its business model, and the stocks. We continue to like and own it here.
Got it. All right. We are going to take a quick break. We will be back with your phone calls for Brian Madden, Chief Investment Officer, First Avenue Investment Counsel. We're back in a moment. And welcome back to Market Call. We're taking your phone calls today for Brian Mannon, who is in-house talking about North American equities. Dominic is on the line. He is calling today from Montreal. Hi, Dominic.
Yes, hello. Thank you very much for taking my call. My call is on Nvidia, and with the recent earnings report that Nvidia just put out, I was really excited to see its price-earnings ratio drop below 30. But then I was also surprised that Trump is considering another 10% tariff on China, on China's previous 10%. Also, with the sales restrictions that Nvidia has selling to China. Brian, can you give me your fundamental analysis on Nvidia? What do you think about it, on its current valuation, and what do you see going forward? It seems like a value here on this growth stock. Thank you.
Thanks very much for the question, Dominic. So cutting to the chase, we really like Nvidia. We've owned it for a long time in our momentum mandate. Take your point, certainly, about the valuation looking compelling relative to its own history. I think it's trading at 27 or 28 times earnings now. And that's in the context of a forward growth outlook over the next 3 years of earnings expected to grow at about a high 20s rate as well. So one of the ratios investors will sometimes make reference to is a price earnings to growth ratio.
Okay.
So values around 1 are really good. Values below 2 are okay. Values above 2 or 2.5 are usually considered expensive. So with that growth outlook and with that price earnings ratio, yes, Nvidia, if they can deliver on the earnings, looks pretty compelling. Also take your point about the China risk. I don't think risks of further tariffs on Chinese imports into the United States are particularly impactful to Nvidia. Certainly will be very impactful to other companies, but the specific risk for Nvidia, obviously we know there's a bit of a Cold War, not a bit, there's a legit full-on Cold War between the United States and China on many sort of different vectors, but one of them is technological supremacy. And so there are export restrictions on some of the most advanced AI chips. And so if those get tightened further, that does pose some risks to the sales outlook for Nvidia, which is already precluded from selling its most advanced Blackwell and perhaps even the younger generation, or I should say the older generation of AI chips into China to a certain degree. But our bullishness on the name is underpinned by the AI revolution. They have the first mover advantage, they have the technological advantage, they have incumbency with most of the hyperscalers that are building data centers as far as the eye can see and throwing hundreds of billions of dollars at them and putting hundreds of thousands of AI chips into them, many of them Nvidia chips. So the demand is there. To a degree, in the short term, they've been capacity constrained on output of some of their most advanced chips, but the underlying demand is there. About 90% of the revenues go into data centers, the remainder into gaming and auto. So great stock, and if you believe in the future of AI, which we do, it's one you want to own.
Nvidia trading at 122. It had a bit of a waffle after it reported its earnings. People weren't really sure how to read it. I mean, they were good, but they weren't awestruck by it.
Well, it's a volatile stock, and it's a hyper-owned and hyper-focused on stock, and people tend to own it like a hot potato with a very, very, very short-term trading mentality. And so it's not unusual to see it move 10, 12, 15% on earnings or any other thing. So, it's the kind of name you want to own in a portfolio. And I stress, in a portfolio, a well-diversified portfolio has lots of different parts that don't all zig and zag at the same time. So positioned and weighted properly in a portfolio, it definitely deserves a spot, we think.
Let's go back to the phones. Michael's on the line calling us today from Montreal. Hi, Michael.
Hi. Would it be possible to have Brian's opinion in regards to Alimentation Couche-Tard? I know you recommended in the past as a top pick, and it's just trading below at the recommended price. As well, can you comment on the news that came out today in regards to the founding family to take it private? It doesn't appear to be going through. And it seems like Couche-Tard is the they have they're leading the takeover. If the takeover doesn't go through of the entire company, would they acquire just the North American assets for 7-Eleven? Thank you very much.
Yeah, that's an interesting question, because usually we get the bigger question, but could they possibly just take over the North American 7-Elevens and not go whole hog?
Yeah, I mean, this is a very, very dynamic story, Michael, and thank you for the question. I'll start off by saying we like Couche-Tard, we own it. I think I've owned it in every portfolio I've managed going back to the turn of the century most of the time. So, it obviously is a leading consolidator of the fragmented convenience store industry, starting from humble roots in Quebec and now global presence, and aspiring to get much bigger should it be successful in acquiring 7-I, the parent company of 7-Eleven. This is a watershed moment for Japan, corporate Japan. Japan has been enacting corporate governance reforms and reforms generally throughout their economy after 2 lost decades. And it started slowly about 10, 12 years ago, and it's been accelerating. They are supposed to be becoming more shareholder friendly and less protective of entrenched incumbent management teams that may be underperforming, which 7-I undoubtedly is. So one to watch, but Alain Bouchard and the management team really, really, really want this one. But make no mistake, they're disciplined acquirers. They want it at the right price, not at any price. And I think there is a deal to be had, and it could be of a creative form like what you suggested, just North America potentially.
Got it. All right, we do have to take a quick break. Brian Madden sticking around to take your questions. We're back in a moment. Welcome back, and thanks for joining us here on Market Call. We want to go right back to your phone calls, get through as many as we can. So Harmon is on the line. He's first up, calling from Nanaimo, BC. Hi, Harmon.
Hi, good morning. Hi, Brian Madden. Could you tell me your opinion on TD Bank, please, and also your number one Canadian bank pick, please? Thank you.
Thanks for the question, Harmon. TD Bank, we own it, we like it. I'd say our number one Canadian bank is Royal Bank, which we think is the best Canadian bank. This one would be sort of neck and neck with one of the others we like and own as a runner-up. Why we like it, the Canadian personal and commercial business is excellent and dominant. The U.S. business is a fixer-upper. We think they will fix it up. They showed good progress in getting after that AML and compliance shortcoming remediation when they reported a couple of days yesterday, actually. The wholesale business, has fits and starts. It's subject to the vagaries of the capital markets. The wealth management business is quite good. Scale, size, addressing do-it-yourself, full service and institutional investors. Do-it-yourself may be one to watch. We think they're doubling down on growth aspirations in TD Direct Investing, which is the leading discount broker in the market. We like the fact that they sold their stake in Charles Schwab for $21 billion and will be buying back $8 billion worth of their very discounted shares with it. So lots of reasons to like it. And, we think the dark clouds are finally parting here on this one.
Okay, TD at about 86, 67 at this hour. Let's go back to the phone line. Jack is on the line. He's calling from Scarborough, Ontario. Hi, Jack.
Hi there. I was interested in CGI. It's in the IT services sector, and I was just wondering if you could talk about why the stock has just dropped today at a 5.5% drop. It'd be really interesting to know if it's a good time to enter or if I should just wait and re-enter at a better time. Thanks so much.
Thanks for the question, Jack. Full disclosure, don't know why it's dropping today. It's not a company that we own currently. We did own it in a fund that we merged into our two other North American mandates about a year and a half ago. So I have followed it over the years. I will say a 6% drop in the stock is noteworthy and unusual for this company. So I'd want to look into exactly what is behind that disturbance. This is a very good company. The stock price chart bears it out. It's operating in Canada, in the United States, and in Europe, and it's got offshore delivery centers in India, I believe. And it should be advantaged by this sort of nearshoring phenomenon. I want to add that. Some of their biggest customers are U.S. federal government, civilian and defense contracts, and also U.S. state and local governments. but they've been doing municipal infill acquisitions of small IT service companies in different markets where they want to have local boots on the ground. And I think that will play well in this Trump 2.0 administration. So, to the extent it's not something materially negative that's driving this downdraft today, probably a viable pullback in this very stable grower and well-governed, well-managed company.
All right, I hope that helps Jack to make a decision. That is all the time we have for calls today. Don't go away, though. Brian is sharing his top picks. That's coming up next. All right, time now for top picks with Brian Madden. He is here to tell us why he has picked, first of all, TFI International. TFI, of course, in headlines recently because it was thinking of moving to the U.S. and got a lot of pushback when discussing leaving Quebec.
That it did, and they changed their mind, and applaud that decision, frankly. Companies exist for the benefit of their shareholders, so shareholders spoke and they listened. And so, kudos to the management company for not being tone deaf to what really struck a nerve there. So we like this company. We own it. Obviously, the stock price chart is not that pretty. The stock has just drawn down on the back of a pretty weak fourth quarter, 40% from its mid-December high. That's the fifth biggest drawdown this company has ever had in its 35 years of trading. And so, for context, since the turn of the century, this stock has generated a total return of 16,000%. So the punchline is pullbacks are buyable, and the 16,000% return is proof positive that management is very capable when problems occur. They're addressed and they're resolved. So we like this company because it's a truckload, less than truckload, an asset-light logistics company. Great management team, lean operating philosophy. They try and sell the right freight that matches their network, keeps the trucks moving. And then beyond that, it's a very capable consolidator of the very fragmented trucking industry. And now it's trading at a discount of about 35% to its trucking peers and at a discount to its own 5-year average PE ratio, now trading at 14 times earnings versus a more typical multiple of 16. So incredible entry point here in our view.
Okay, let's go to Alamos Gold, which is your next top pick. Tell us why you like Alamos.
So this is what people used to call a mid-cap gold miner. It's now a $14 billion market cap. So you might say it's a large cap company or emerging large cap company. 2 mining districts in Canada, 1 in Mexico. We really liked their acquisition last year of Argonaut Gold for about $800 million, I should say. Very attractive and compelling opportunity to realize $375 million of life of mine operating and general and admin costs, and as well avoid $140 million capital spend by milling the ore from Island Gold at the adjacent Magino mill via one mill. And then beyond that, this is a company with a great organic growth profile, very visible path to 1 million ounces of production between now and the end of the decade. That would be a 12% annual compound growth rate in production. And Marilla, there is no mid-cap or large-cap company that can match that. And finally, icing on the cake, whether on a standalone basis or appeal to a strategic acquirer that's growth-starved, this company is operating in negligible geopolitical risk jurisdictions, Canada and Mexico.
Okay, we've got to move on to your last one, which is Nutrien. What's going on there that you like?
This is the world's largest agricultural crop nutrient business. It's got 2 upstream segments, mining phosphates and potash, and also producing nitrogen. That's vertically integrated with a downstream retail farm supply store of about 2,000 stores in Canada and the United States. It sells seed, fertilizer. They do financing, merchandise to farmers. And the punchline here, or the primary sort of aspect of our bullish thesis, is we think the commodity prices for all 3 of their crop nutrients have bottomed, supported by high and rising cash crop prices. and also the unavoidable imperative that farmers have to replenish depleted nutrients in their soil because they were very sparse and judicious about applying fertilizer when prices spiked, 3x after the Russian invasion of Ukraine. So you can mine the soil, as they like to say, only for so long, and then you have to reapply. So we think there's going to be a replenishment demand cycle for potash in particular. The company is getting after some cost savings and efficiencies in the Brazilian business, which has been problematic. Dividend yield is about 4%. The stock's trading at book value, bounced about 30% off the low, but we see a lot of upside here still. So recently added this to our dividend growers mandate.
Got it. So that was your third topic, was Nutrien. We have to leave it there. Brian Manister, thanks for coming in. We'll see you again soon. And thank you for watching us here on Market Call. We'll be back again on Monday. Have a good weekend.